Good morning, everyone. Time for another silver update. What you're looking at is a ascending wedge formation, flag formation, that we're currently in the process of breaking out of. This is the 30-minute silver chart. So you can see that we are following the slower trend line of the formation and then rising sharper and sharper. So we're just pulling now back to the breakout line. We did a strong breakout to 41.47. So taking it back out to the daily chart that I notated before, we have, well, let's pull out to the 8-hour. We can see it more clearly. I had pointed out that we had a consolidation point in and around this area, which was consolidation resistance. Basically what I mean by that is that the longer that a price has traded, the more time that a price has stayed in a particular area, there's more chance for positions to be taken and therefore more resistance to form. You can see that this price area caused resistance to the rally to fail back here. Wasn't tested again until here, and then we got through it. The next area that I've been looking at is this area right here, which significant price consolidation, well, not significant, but relatively significant price consolidation occurred, and we're now testing that area. So with this breakout of this wedge that we're looking at here, it's going to be a test of seeing whether we can get through that area. It's important to note that this breakout is occurring on the morning session. Traditionally, the night sessions are rallies, the morning session are pullbacks, and that's primarily because the trading in Asia goes on during our night time, and the trading in New York goes on while our markets are open. So normally the best time to see a smackdown is about 8:30. So if we go back to the 10-minute, you can see we had a big smack around 8:30 is the New York Open here. And then we had one, well, this one kind of went counterintuitive. We had a smackdown and then a rally. This one we had a smackdown around 8:30. This one we had a rally overnight and then a little bit of a sell-off at 8:30. We had kind of a sell-off there. So this morning we have a small rally overnight and then a little sell-off and then a rally right now. The reason I'm pointing this out is because the key factor that I think going forward will be the fact that since a real market has opened up that's an alternative to the COMEX in Asia, the extent of their ability to smack the price down may be limited, and they may be forced to buy in New York. Now, if they're buying in New York and they're buying in Asia, what does that mean for the price? So this could be a critical change. We'll just have to wait and see if it is. But if we see strong buying in Asia and then strong buying in New York and then strong buying in Asia, we're just going to see the price rocket higher. Let's jump over to the latest Jim Willie. I actually should have covered that when it came out, but I didn't because I just didn't catch it. I don't have it on any kind of, I just search for it every once in a while. He usually puts one out once a week or once every 2 weeks. This report here is really good because he takes on what he calls the deflationist knuckleheads. And these are people like he's got a friend here, Tom V, that he talks about. These are people like Robert Prechter and all the other deflationists. There's not that many left in that camp because they've just been wrong for so long that they won't give up. But most have given up. But people like Prechter obviously will never give up. So, but he really takes them on here. I'm going to read a little bit of this and then I want to get to my main point here. The economic theory in textbooks must be updated to account for fiat soft science. An important third factor determines prices. It is not demand, as most deflationist knuckleheads claim. It is not supply, as the moronic followers of the Laffer curve advocates insist. Instead, it is the falling U.S. dollar, since all commodities are priced in U.S. dollar terms. Lower demand will not result in lower commodity prices, since the monetary effect trumps all. The twist lies in the pricing denomination units, not in price-demand dynamics. An inflationary recession is deeply rooted in progress, with a depression next to occur. The price effects continue to confuse the challenged economists who have actually foreseen almost nothing in the current ongoing crisis. Their collective value is far less than garbage collectors who tend to the landfills or landscapers who improve the appearance of home lawns. The crisis towards wreckage all occurs like a wrecked house floating over a waterfall for all to observe in sheer horror, as wealth evaporates and national sovereignty is forfeited to creditors. What follows is my analysis of the erroneous path taken by the myopic deflationist fools. The entire table of commodity prices is rising. Since the advent of QE, QE Lite, and QE2, the full price structure has been rising steadily and noticeably. As the US dollar declines in value, the price of any commodity priced in US dollar terms rises. The US dollar is not the constant, as they, along with Wall Street mavens, believe. Gold is constant, and the US dollar is falling versus gold. This is basic science, but something that demand-side deflationist fools miss, and something that supply-side Laffer fools miss. It is best to offer some solid evidence to these people with dull intellectual capacity and move on without waiting for their awakening. Sadly, it is over their heads. Gold is the constant, as the US dollar moves in shifting patterns within its stable golden sphere. The commodities, therefore, all change in US dollar terms as a result. The knuckleheads miss utterly basic principles, spout nonsense repeatedly, remain steadfastly ignorant of their errors, learn nothing in the process, sound arrogant while on the wrong path, and continue to litter the landscape with their mental drivel. They are an annoyance, even inside the gold community. As the US dollar and all major currencies lose value from grand debasement, the vertical scale loses its price delineation markings. The entire vertical price scale itself suffers from inflation. The numbers blur, only to come into better focus with different numbers tied to the vertical tick markings. What used to be $8 is suddenly $10. What used to be $40 is suddenly $50. What used to be $120 is suddenly $150. The deflationist knuckleheads expect that slower economic activity will reduce demand and thus bring about lower price. But they miss the bigger effect of price scale alteration and decay, the result of currency instability. The fiat paper monetary system, based upon denominated debt rather than sacrosanct inert metal with no counterparty risk, is decaying into an international scrap heap. All price dynamics change. It's that simple. It's that complex. The Honorable T. Ferguson pitched in with a comment that sets the tone. He said, "Remember Econ 101. Increasing the supply of an item decreases its value. More dollars equals less valuable dollar. A declining dollar causes all things denominated in dollars to rise. The dollar is going to be declining farther with the advent of QE3. So the way must be prepared by smashing commodities first so that they start their next up leg from a lower point. Thus the fundamentals are overridden." And he goes on, he completely decimates the deflationist school, which obviously by their predictions they've been wrong time and time and time again. So it's an excellent article, and I encourage you to read it all the way through. You can see that with the breakout here that we have with silver, that silver obviously is giving lie to the economic fright, deflationist fright type of scenario where they always try to scare prices down by threatening that things are going to slow down. Silver is more vulnerable to that because Silver, unlike gold, has an industrial component, and it can always be scared in price that, well, we're going to collapse the entire system and then there'll be an overabundance of silver. And that's the other issue I wanted to talk about, and I have a chart that I picked to describe that, although it's very difficult to find good charts on this. So this chart is what I'm going to call Weekend at Bernie's. I don't know if you're familiar with Weekend at Bernie's, but here's a picture. If you remember that movie, this guy, Bernie, in the center here, he died, but I don't remember the exact plot, but for some reason these guys had to pretend that he was alive. So I'll call this COMEX over here and the LBMA over here. So these guys have got to drag Bernie around to various parties and to various events to convince everybody that Bernie's still alive. This is Bernie here. This is the COMEX inventories. This is not the latest. This goes through May, but you can see, and I've tried to find, because the first chart I was looking for was, you can see I searched for silver supply graph. I'd really like to find a chart that shows the silver supply or stockpiles. We know they were at one point as much as 10 or 20 billion in this country, very high in World War II, and then consistent. It would look something like this chart. This is on a shorter term, but you can see that I think we're already at the point where these guys are dragging Bernie around. So Bernie is the silver supply, and it's dead. And the COMEX and the LBMA are dragging it around, pretending like it's alive. And why is that the case? Well, it becomes a lot clearer when you understand that this price chart, more than anything else in the world, gives lie even more than this price chart of gold. Because what Jim Willey pointed out is that the price structure of commodities is determined primarily by the money supply, the amount of dollars that's out there. Yes, on a smaller or shorter term basis, supply and demand determine the movement of price in that shorter term basis, but ultimately it's the debasement of the dollar that's going to determine price. So the reason why I'm pointing this out with silver is because at the same time, when silver is below its all-time nominal high right here, as gold is not, and as I pointed out, as everything else is not, as the price is rising, it's obviously not rising fast enough, because here's the double whammy. The dollar debasement that's occurred, silver hasn't anywhere caught up to that yet. But even worse than that, there's this explosive demand situation that's taking place, where already the silver that is in demand doesn't exist. They're playing this Weekend at Bernie's game, where they're shuffling this dead guy over to one party and then over here, and he's got to make his appearance everywhere, and that's the phantom supply of silver. They've got to, convince some people not to take delivery by paying them off in cash, and try to discourage these guys from shipping it out, and slap a bunch of pieces of paper over one vault that has some silver bars in it that say that 10 different people own it, and change it around. A lot like Weekend at Bernie's, because it's dead. The silver supply is dead, and they won't let the price rise. So this situation is much worse than Jim Willey says. Silver has lagged the dollar destruction and is already should be around 150 to 250 just based on the dollar destruction. When we add in this Weekend at Bernie's effect of the silver supply, it should at least do another 2 to 3 fold from there. So right now, silver should be trading at least $500 an ounce based on these two factors. So now you know why the desperation is so great of those who seek to suppress the price of silver, because this, today's move should go through 49 and the next day blast $20 or $30. If these people got out of the way and all the people that wanted to buy to protect their dollars could buy, and all the people who are in the game knew what the situation is for the silver supply, I'm totally convinced that this price would start moving in 5, 10, 20, and even 30, 40, $50 increments until it moved up to a reasonable price of, I would say, at the present time, around $500 would be a price where perhaps this dynamic of this destroyed silver inventories could start to be repaired, where perhaps new forms of recycling could come out, where a lot of the coins and bars and stuff that wasn't teased out of hiding by high price in 79, which, by the way, that equivalent price is in the hundreds of dollars to tease that same silver back out. Something like 500 is what it's going to take to bring those hordes back to the market, which I don't think are that great, to open up new silver mines, strictly silver mines, not byproduct mines, and to encourage some type of recycling situation where we're not constantly throwing all the valuable, scarcest resource in the world, soon to go out of existence, into unrecoverable landfills, as we just toss these cell phones and all these electronics into landfills because they've suppressed the price of silver so low that it can't be recovered. So this is just the beginning. This is just the beginning of, in my opinion, what's going to be a huge move. I've predicted that this area is going to be taken out in the fall. It could be taken out before that. The shenanigans that are going on in Washington are absolutely shocking. They, as I said from the very beginning, this debt ceiling debate is thoroughly disingenuous, and this talk about a balanced budget amendment is just plain stupid. You have a balanced budget law right now. It's called the debt cap, and all you have to do is follow it. It's not that hard. You have $300 billion in interest payments, and you have $2.2 trillion in tax revenues. That leaves you $1.9 trillion in money that you can spend. You're spending $3.7 trillion. So if you cut that by 50%, that will put your spending at 1.8, 1.9, 1.85. That would put us even, and maybe even a little bit to salt away to start to pay down the existing debt. Will that happen? Never. That's never going to happen. That's why this price is going to keep rising. They're going to keep printing money. But the point is that they could deal with the debt and deficit right now. What we need is an across-the-board 50% cut in everything. Military, entitlements, every single penny the government spends, or every single dime the government spends, needs to be a nickel. That's what it would take to deal with this situation. There's obviously no way they're going to do what is required. Would be far too painful, and the consequences, we don't even know what they would be. Cities burning, rioting, looting, we don't even know. So the path is set. They can't go back. Once this cap is raised, they're going to have to institute another round of qualitative easing, because it will be obvious that we have no intent of paying off our debts or even reducing our debts. We only intend to increase our debts. Therefore, there won't be anybody to buy our bonds. Therefore, the Fed's going to have to buy our bonds, and therefore we're going to need more qualitative easing. So the road is already set. The doom of the dollar is sealed, and you can see that, contrary to the dollar chart, which I don't really follow because it's a basket, if we look at the yen chart, we can see that they've pretty much given up defending this Fukushima drop, and we're going to plumb new depths in the dollar yen value. Same thing is going on with the Swiss franc, which is the other one I follow. The dollar is plumbing new depths against the Swiss franc. So the dollar is falling. It has to fall. The course is locked. We're set to continuing inflation, as Jim Willey points out, and there's no escaping the situation except printing more money and an eventual hyperinflationary blowout and collapse. And we'll talk to you next time.